Hey everyone, welcome back to Corporate Decoder, the place where we crack open the toughest corporate documents to find the real story. And today we are diving deep into the financial guts of a fund that's playing a very complex game. Think intense strategies, potential for big wins, and yes, some pretty significant risks. It is a fund aiming for consistent returns across all sorts of market ups and downs, so let's see what's really going on under the hood. Before we jump in, if you dig getting the unfiltered truth from corporate filings, make sure you've hit that subscribe button. We also have a community Discord linked in the description below where you can chat with other finance enthusiasts. Alright, we are looking at a filing from Wellington Global Multi-Strategy Fund. This isn't your typical stock or bond fund. This is an interval fund, which means it has got a unique structure for offering liquidity and it is playing in a space where strategies can get pretty sophisticated. They are filing a post-effective amendment, essentially updating their registration statement to reflect their current business and offer more shares. This fund's main goal is pretty straightforward on the surface: to seek consistent and positive returns no matter what the market is doing. But how they plan to do that is where it gets interesting. They are using three main strategies: equity, long, short, macro, and fixed income and credit. Each of these has sub-strategies managed by different teams. They offer three classes of shares: Class A, Class I, and Class M. Each class has different fees and investment minimums, which is pretty standard, but it's worth paying attention to how those fees impact your actual returns. Speaking of fees, let's take a quick look at the fee structure. This is where things can get a bit pricey for investors. The management fee is 1%, which is fairly common, but then they've got this reimbursable pass-through expense, which is listed here as 1.43%. That's a significant chunk. Now, this reimbursable pass-through expense is essentially the cost of paying the trading team personnel who manage specific strategies. This means the fund pays out a percentage of its assets to these teams, and it looks like it adds up even after expense reimbursements. The total annual fund expenses after reimbursement are looking like 4.82% for Class A shares, 4.57% for Class I, and 5.32% for Class M. That is considerably higher than your average mutual fund. So while they are aiming for great returns, a big chunk of those returns goes right back to the managers and teams involved in running these complex strategies. The example here shows that for a $1,000 investment assuming a 5% annual return, investors could pay anywhere from $46 to $53 in expenses per year, depending on the share class. That might not sound like a lot, but over 10 years, for that same $1,000 investment, you're looking at paying between $589 and $636 in fees and expenses after reimbursements. This is a really important point. High fees, especially performance fees and pass-through expenses like these, can significantly eat into your actual investment gains. It's like running a race where you're already giving the competition a head start. Now let's talk about risks. This fund is not for the faint of heart. They admit their shares aren't listed on any exchange, so this is not a liquid investment period. You can't just sell them whenever you feel like it. They offer quarterly repurchase offers, but there is no guarantee you'll be able to sell all you want when you want. And if many people want to sell at once, you might get prorated. They are also non-diversified, which means they can put a lot of money into a single company or sector. This can lead to bigger gains if things go well, but it also means bigger losses if that one investment or sector tanks. And because they are dealing with complex financial instruments and digital transactions, cybersecurity is a significant concern. They mention the risk of breaches, data corruption, and ransomware. Interestingly, they also talk about crypto assets, but indirectly through ETFs, futures contracts, and derivative instruments. They acknowledge the extreme volatility and regulatory uncertainty surrounding crypto. Looking at their compensation structure, they have a performance fee. This means the advisor gets paid a percentage of the profits, and this can be a strong incentive to take on more risk. They are entitled to 20% of the net profits after accounting for a loss carry forward. And that reimbursable pass-through expense we saw earlier, it is calculated based on the net profits of the underlying investment teams, and it can be paid out even if the fund itself doesn't have overall positive performance. That's a pretty aggressive compensation model. Let's check who's really in the driver's seat. Wellington Finance and Treasury LLC is the primary holder, especially with Class A and Class I shares. Owning basically everything, this means they have significant control. For Class M shares, a large chunk, over 75% combined, is held by various customer accounts through Stifel Nicolaus & Company Incorporated. This suggests a concentration of ownership among a few entities, which can influence fund decisions. The fund is overseen by a board of trustees. They have 3 independent trustees, which is good for oversight, but one trustee, Molly K. Shannon, is an interested person because she is with Wellington Management. The board structure seems standard with committees for audit and nominating and governance. The independent trustees receive a healthy annual retainer, and they are reimbursed for their expenses. But here is a key thing. The interested trustee, Molly K. Shannon, receives no compensation from the fund, which is typical. The other independent trustees are compensated. And the amounts are fairly substantial, especially considering they oversee these complex strategies and high fees. So, what's the overall story here? This fund is designed for sophisticated investors who understand and can tolerate high fees and complex strategies. They are aiming for consistent returns by diversifying across multiple investment teams and strategies. But this approach comes with significant costs. The high expense ratios and performance fees mean that the fund needs to perform exceptionally well just to deliver decent net returns to investors. The risks, ranging from market volatility to cybersecurity and the unique challenges of an interval fund structure, are substantial. While the fund offers some liquidity through quarterly repurchases, it is far from a liquid investment. In conclusion, Wellington Global Multi-Strategy Fund is playing in the big leagues with a strategy that demands serious skill and carries significant costs. The potential for high returns is there, but it's heavily dependent on the expertise of their numerous trading teams and the advisor navigating complex markets. For the average investor, especially those not accustomed to such high fees and limited liquidity, this fund is likely not the best fit. It's a high-stakes game, and investors need to be absolutely sure they understand all the risks and costs involved. What's your take on this aggressive fee structure and the interval fund model? Do you think the potential for consistent returns justifies the high costs and risks? Drop your thoughts in the comments below. If you found this deep dive valuable, hit that like button, it really helps us out. And subscribe for more insights from the heart of corporate finance. Don't forget to join our Discord community, linked in the description, to keep the conversation going. Thanks for watching, and we'll see you on the next episode of Corporate Decoder.